Our guests today are dear friends of mine, but more importantly, they're dear friends of each other. Keith Higgins recently retired as a partner of Ropes and Gray up in Boston. Not too long ago, he served as the director of the Division of Corporation Finance at the SEC. Scott Spector also recently retired at Fenwick and West out in Mountain View. And Mark Borges, well, he's still working at Compensia. He's toggling between San Francisco and Washington, D.C. We're going to talk Rule 701 and Form S-8 on Brock Romanek today on Zippy Point. The gang's all here. So glad to get you dear friends together, and perhaps what might be your last panel together, maybe not. We have two retirees, a lot of pressure on Mark here. I'm going to put more pressure on Mark because I'm going to have him kick us off with the background of what we're going to be talking about here, 701 and S-8.
Thanks, Brock. We're going to basically talk about something that the SEC did quite close to the end of the year. They were very ambitious this year in terms of getting out rulemaking projects. And even though this was something we had hoped for quite a while, I think we were all just a little surprised that they were able to actually convert what was a lot of ideas into a proposal, many of which I think make a whole lot of sense and are going to simplify life for companies issuing securities to their employees, particularly private companies. Essentially, what the proposals do are modernize the two mechanisms by which companies grant securities to employees in compensatory transactions. On the one hand, you have Rule 701, which is used by private companies, and then the specialized registration form, Form S-8, which is used by public companies. Historically, if you look at the rules as they've evolved over the years, the SEC has always sort of given special treatment to the rules having to do with the issuance of securities to employees, kind of citing the special relationship between an employer and employee. The S-8 rules are not as stringent as the registration requirements are for a lot of other forms. And in fact, over the course of our career, we've seen the S-8 rules become less and less stringent as they've simplified them and in order to try to minimize the administrative burdens associated with issuing securities by a public company to its employees. 701 sort of has the same concept behind it. It's a little bit different. Things are a little bit trickier because private companies don't have quite the same flexibility that public companies do in order to be able to issue securities. So there are a few issues there that we're still struggling with, and that particularly given the changes in the economy that have taken place over the last 10 or 15 years have been exacerbated in Rule 701 in a way that we haven't seen in Form S-8. This all really stems from a concept release which the SEC put out in 2018. In 2018, under congressional mandate, the SEC amended Rule 701 to increase the amount of securities that could be offered and sold in a 12-month period from $5 million to $10 million. And at the same time, the SEC decided that it was high time to modernize, or to at least consider modernizing Rule 701 and S-8. So they issued a concept release which asked a lot of questions about some of the more common issues that they had received over the years about the problems with each of these particular forms. I would say that probably the majority of the comments that came in were very supportive of simplifying the rules, and in fact, even perhaps getting rid of Form S-8 altogether as being something that's really an anachronistic registration statement that doesn't really serve much purpose other than to collect a fee for the SEC and to help train lawyers on how to do SEC filings. The concept release considered a variety of different topics. Under Rule 701, they looked at the exemptive conditions. They looked at the caps on how much it could be offered and sold over a 12-month period. And they looked at the disclosure requirements in terms of what has to be provided to employees or recipients of stock in conjunction with qualifying to use the exemption. And for S-8, they looked at a variety of different ways to ease the administrative burdens associated with compliance with the form. For example, registering multiple plans on the same Form S-8, coming up with a different methodology for how you would pay the registration fee for the shares that you were going to sell, and registering qualified plans based on a dollar amount rather than on the number of shares issued. A lot of these were ideas that had been kicked around for a number of years and had been raised with the SEC individually. They sort of assimilated them all into this concept release and basically put it out for comment. They got 22 letters, including letters from the ABA, the Chamber of Commerce, various law firms, suggesting that, or endorsing generally the concepts that they were asking about, and perhaps even asking them to go a bit farther than they were prepared to do in order to try to resolve some of the headaches that practitioners experienced in dealing with having to comply with 701 and to make registrations for a public company. In fact, in 2019, I think at the annual meeting that the JCEB holds every year with the staff of the Division of Corporation Finance, we spent a considerable amount of time advocating for a few of the changes that we see in the two proposing releases, which came out in the last quarter. So I feel like our efforts were not without some benefit. And I think at this stage, it's really a question of kind of getting some of the kinks ironed out in the proposals. The SEC didn't go nearly as far as perhaps I think some of us would have liked them to, although as Scott's going to talk about a little bit later, they did introduce the notion of non-employees who work for gig economy companies being able to receive stock under the securities laws, which I think is a big step forward if in fact it ultimately gets adopted. So sort of with that introduction, why don't we go through the different sets of provisions here. There are actually two releases. There's one which is, Keith and I are going to talk about, which modernizes some of the issues with Rule 701 and Form S-8. And then there's a separate release on the use of Form S-8 and Rule 701 by so-called platform workers, which I think is the more revolutionary concept and the one that Scott's going to talk about.
Great. Thanks, Mark. As Mark said, the SEC has over the years paid special attention to employee stock offerings and has made the S-8 a very useful and convenient method of registering these offerings to employees. I had to chuckle when he said the SEC has tweaked it during our lifetime. Actually, for a lot of people on this who are watching this, probably hasn't been during your career, since in 1990 was about the last time I think the SEC did anything significant to Form S-8. Imagine before 1990, the prospectus had to be included as part of the registration statement. It was filed. Imagine that would be on Edgar these days. Obviously, a lot of
Keith, one addition to what you just said, not only have they not had a rule release in 20 years, but they have had, like, I think only one letter ruling, or no action letter, I should say, that has dealt with S-8. They've had a number on 701, but S-8 had only, I think one letter in that 20-year period.
Well, of course, the good news is that since it goes effective automatically, it's not the kind of thing the staff is really looking at. But in any event, the registration of employee securities made pretty simple, but securities offering reform came around in 2005 and sort of leapfrogged over S-8 in terms of convenience with the automatic shelf and the WIXI shelf. In any event, this is a bit of a catch-up. As Mark said, these changes are not revolutionary. They're largely incremental. They received the support, at least at the proposal stage, of Commissioners Lee and Crenshaw, which isn't always a sure thing on these so-called modernization issues. I think, as I say, I think it's incremental. I think there were some missed opportunities, which we'll talk about at the end, but let me just turn now to the principal changes that are being made to S-8. Excuse me. First, the SEC is going to allow people to add additional plans to a Form S-8. Not revolutionary. Indeed, they're saying basically they're clarifying that you're permitted to do that. When does that occur? That occurs very frequently where you've got an old plan that's expiring, still has some shares left in it. You adopt a new plan that says we're going to put 1 million shares in it, plus anything that's left over from the old plan that isn't used by the time of its expiration date. To register that, it was always tricky. You didn't quite know how many shares to register when you were registering the new plan. And so it was quite, the way to do it was to take the old registration statement that covered the old plan and amend it to include the new plan as a permitted form of distribution, an alternative form of distribution for the remaining shares. You put a little narrative in it, file it as a post-effective amendment, it would go effective automatically. The SEC is now saying that's permissible. We're clarifying that you're allowed to do that. And so after all these years, which I've continued to do it, I'm happy that they're making me an honest person. They're also proposing to allow shares of multiple plans to be registered on one S-8. Now, many of us have been doing that as well for a long time. So
that was a bit of news. Yeah.
Right. Well, I think they said, we think that you can do this, but we want to make sure that you know that you can do it. So that's great. So you can put the plans on the front cover, and you can put a pool of shares that cover them all, and you don't have to allocate amongst the particular plans. Save one thing, which we'll talk about in a second, as relates to qualified plans, where they've come up with a different construct. The SEC is also, and this is actually a little more revolutionary, will also allow you to add shares to a registration statement by means of a post-effective amendment. Now, all of you securities wonks out there know that Rule 413 says you can't add shares to a registration statement by means of a post-effective amendment. And the way the SEC has gotten around that to date with S-8 is to allow you to file a new registration statement that allows you to incorporate by reference everything from the old one into it and get you the new share. So it threads the needle on 413, but makes it a little bit simpler. Here, they're going to make it even simpler. You'll be able to file a post-effective amendment that adds new shares. It'll go effective automatically. And just think about that. You won't have to go out and chase your directors for new signatures because you'll have the power of attorney from the old one that you can just sign on. So it'll make it, at the margins a little bit simpler than it has been to date. I mentioned they were going to do something different with qualified plans, and they are doing something different in the fee area. They're essentially going to require all companies to register an aggregate offering amount, a dollar amount of securities, rather than shares for qualified plans. Currently, you can do that under Rule 457.0. This is going to be a mandatory situation where they're going to require you to do it. And the sales will be based on the dollars invested, and you'll nick the amount of securities registered by the amount of investments that come into the company stock fund. One benefit to this is, and I know many probably in the audience have had this particular situation. You file your registration fee within 90 days after the end of the year by figuring out how much you issued. So you're not going to be in a situation where you find out, oops, I don't have enough left on the S-8, and oh, by the way, we've been offering shares under our 401k plan forever. Now, They did ask a question about share counting. One issue that has been kind of nettlesome about qualified plans is people have frequently taken the view that only the net number of shares, where you've got buys and sells happening between the company stock fund at the same time, that the trustee, as an administrator matter, nets out. Some people have taken the view, well, you should only nick the net shares against the total offered. The SEC's preliminary view, which I think is probably right, is that that's not the appropriate way to do it. To the extent that this constitutes an offer and sale of securities, you've got to look at it on a gross basis. The person who's buying it, it ought to be irrelevant that somebody else is selling it.
Keith, not to be flip or sarcastic about this, but that is the one item that you've mentioned so far. In fact, probably the one item that we'll talk about that really is a money issue. I mean, to the SEC, because theoretically you get additional fees. Actually, you get additional fees for registering more shares and not netting. And, you know, in past discussions, you know, we've always, at least internally, kind of laughed about the fact that they're never going to give that up because it's all about money. And, you know, why would the SEC give up money?
Right. Other than when you look at how the SEC is funded and the fees paid, it's the fees from stock transactions on the exchanges so far dwarfs the registration fees, particularly registration fees on S-8, that, you know, it's really, it really is no comparison. The SEC did a few things to conform S-8 with Rule 701 and took away some things that have been a matter of friction. One relates to former employees, particularly in an acquired company context. What they've said now is that if you have a former employee of an acquired company who still holds, say, an option, and that option gets swapped in the merger to become an option of the parent company, that former employee of the acquired company is going to be allowed to use the S-8 of the parent company for purposes of
and let me stay with that and add to that, because I mean that's really important, I think, to you know, M&A generally, because it has caused companies in the past to have to deal with this issue when, for example, you have directors of a public company that aren't going over to the new public company, and you've got to force them to exercise their options immediately beforehand, or not be able to sell them under an S-8. It's caused you to go through circles and teams in terms of dealing with people that are former employees and not coming over. And you know, some companies ignored the rule as it existed, but this makes it simple, and it makes so much sense. I mean, the fact is, former employees have as much relationship with the issuer and the you know, on the transaction that current employees have, and you just have to get over that. And apparently, they're willing to do that.
Yeah. The other thing they've done is they've allowed service providing entities that are owned by fewer than 25 natural persons to be eligible under S-8, and same under 701. And Mark, you may touch on that when we get to it. They did some tweaks around the IRS determination letters for qualified plans. I don't think I'll go into that, but it makes it marginally better. And they've taken away the obligation to discuss the tax consequences to the issuer of the stock plan in your prospectus. So there you have it. I guess before, Scott, I want to talk about 423 plans, but before getting off qualified plans, I just want to say that was one of the missed opportunities, I personally think. I think it should have been easy for the commission to look at qualified plans and say, hey, ERISA really covers the waterfront here. Do we really need to overlay the protections under the securities laws for employees who, after all, are participating in employee benefit programs? It really is it's an administrative burden. And despite the fact of the commission saying, oh, well, they got Section 11 protection, they got Section 12 protection, I view that as totally illusory and not just not worth the candle. And or the ERISA protection, I think, is far more relevant and far more important. But in any event, there we have it. What they do with 423 plans, Scott?
Yeah, 423 plans has been this kind of outlier from what you would have expected with respect to a company going public. And what the SEC basically kind of came up with initially, going back to 1990, was that you couldn't take a 423 plan, as most companies use it at the time of an IPO, where employees get the first day price and make elections ahead of time, register for the 423 plan ahead of time, because they had this thought process that since you weren't public, employees couldn't make elections under an S-8 prior to the time that the company was public, and you couldn't put the S-8 up until you were public. And so it caused companies to go to come up with a fix, which they did largely in part because of an ABA letter that we put through in 1991.
But that was a little complicated, wasn't it?
It was very complicated. It means that you've got to basically design your first period where employees are automatically eligible for the entirety of the of whatever is being offered to employees, and then they can elect out of that after the IPO, after the company goes public and the S-8 is effective. And you could do it. It's just stupid. It was awkward, and a lot of companies actually probably made mistakes doing that. So what they said is, just like you can register options going forward on day one and have that covered under VS-8 with no special rules for existing employees or existing options that are options, or existing RSUs that are RSUs. They basically said that they're going to take under advisement, and they're going to look at the comments, and they're going to think about whether they should change the rules so that you can register people for these arrangements before the IPO, so that they immediately go into effect on the IPO, recognizing that employees can always elect out. The design of these plans lets people elect out anytime during the period, and maybe they'll put some restrictions in there, but I think that will end up in a good place.
Before we turn to 701, let me just say the other thing that I think is a missed opportunity is just the anomaly, as Mark will explain in Rule 701, that private companies can issue millions of dollars worth of securities to their employees. If they go over 10 million, they have to provide financial statements, but they can do that up to 15% of their outstanding shares in any 1 year. But once they become public, they can't do that unless they file an S-8, which goes through all this rigmarole, when in fact, at that point, there's more information about the company in everybody's hands than you'd ever get in connection with Rule 701. And the SEC said some stuff in the release about, Section 11, Section 12. I just think that's, nonsense. I just don't think that's relevant. These are employee benefit programs. These are, sure, there was fraud going on with S-8 back in the 90s, and they ought to go after that and the like. But to think that employees really need all of the protections of the liability provisions of the 33 Act, I don't buy it. Mark, 701.
Mark, before you jump in, let me add one more thing, and we're going to talk about it now, but I want to mention it. They also permitted, in very specific situations, the issuance of securities under the plan that are registered to entities other than an individual, and that's words, not a natural person. And the restrictions basically are that it can't be too big, that it's really got to be a very confined company with service providers that are providing services on behalf of the company, on behalf of the LLC, to the company in a form for tax purposes or otherwise. And that's a good change. But a missed opportunity here also is that, right now, unlike 701, because this is a registration, if your plan that you're registering stock under is basically permitting people other than people that can take advantage of S-8 to participate, it disqualifies the entire registration, and that's a problem that doesn't exist with private companies. You can have a plan that says you are going to give securities or issue options to people that aren't otherwise eligible for 701 if you wanted to, and S-8 doesn't do that. And I think they ought to conform that to 701 too. But we'll get to that at the appropriate time.
Well, it's interesting. It's interesting to see that the two are converging. It's not happening as fast as perhaps I think the bar and the companies would like, but it is heartening to know that they are sort of making a lot that's in 701 and S-8 similar, so that there isn't a big distinction that you have to worry about when you transition from being a private company to a public company in some of these particular situations. That the issues for 701 really revolve around disclosure and the amount of securities that you can offer in any given 12-month period. I think the biggest headache, and this, to me, this stems from the fact that when Rule 701 was originally adopted, I think the model that the SEC had was a very small private company that would be issuing maybe not penny stock, but certainly stock that didn't have a significant market value to it. And therefore, it was a way of allowing employees to participate in the company's equity program without having to go through some of the gymnastics that one had to otherwise deal with in trying to find a suitable exemption for qualification under Section 5 of the Securities Act. What wasn't anticipated was how businesses would grow, the whole idea of unicorns, the fact that companies would stay private longer, would be fairly large in size and be issuing millions of dollars of stock over time to their employees and other participants. And those headaches really became apparent in the technology sector a few years ago. And I think Scott and Keith and others have been kind of beating their heads against the wall and trying to figure out how to make the rule work in a situation that it wasn't probably intended for. The biggest issue right now, or at least the one that seems to crop up most often, is that if you sell securities within a 12-month period with a value in excess of $10 million, you have to provide specific information to the recipients of those shares before the date of sale, the most important of which is the financial statements of the registrant. And these financial statements have to be within 180 days of the current as of 180 days of the date of sale. But the issue was trying to figure out when you're going to cross that line and exceed $10 million, because the way the rule works, if you don't provide that information to all of the recipients of the shares during the 12-month period, you lose the exemption for the entire period of time.
For everybody.
For everybody. So the companies had to figure out a way to sort of, as they got closer to that number, to keep track of things so that they were issuing the disclosure on a timely basis without running the risk of jeopardizing the offering as a whole. So to me, probably the biggest proposed change in 701 is the SEC's proposal to soften the blow a bit by saying that if you exceed $10 million, it's only the investors who receive the shares above the $10 million who have to get the additional information that's required under Rule 701E. That way you don't have to go back and try to look back over the period of time to figure out where you are at any given moment and worry that any particular issuance is going to take you over the threshold. And if you don't provide the information to the other people on a timely basis, that you're going to blow the offering for the entire offering itself.
So Mark, let me add in there for a second. And perhaps you were going to get to it, and I'm just jumping in unnecessarily. But we also asked in the ABA letter for a grace period so that you didn't have to do it immediately. So you didn't have this footfall that you went over 10 million. You didn't realize it for a month, and now you've blown it. And we asked them for some period of grace after you crossed the $10 million mark. They did not give that to us specifically.
Right.
And that's a problem. We ought to ask for it again, I think, in the comments. And secondly, going to your point about, the fact that this is prospective, which is what you just said. That's kind of like a false. It's a true statement, but it's a potential issue, because practically speaking, once you go over the $10 million and you give it the disclosure to the people in that offering period that are over the 10 million, you got to really give it to everybody, because you can't have a situation where you're giving some disclosure to some people and other disclosure, and the same disclosure isn't going to other people who may be exercising effectively the same option that everybody else is exercising. And so practically that, while it's helpful in that it gives you a little bit of space in case you do blow it, as a practical matter, it may not be very useful to people.
Otherwise, you end up with two classes of employees, those with information and those without.
And you leave yourself open not to an SEC issue, but to a 10b5-1 fraud claim. So I think as a practical matter, that's going to have limited utility. The grace period actually probably would have been more helpful.
Yeah, and that kind of leads to the second issue, which is the what information has to be provided. When under 701, you have to give a copy of the plan to the participant, and when you hit the $10 million threshold, there's additional information that has to be provided in terms of disclosure. But the most important thing is the financial statements of the issuer. And that's always been the most bothersome piece for a private company, because they were expected to provide their financial statements to the employees in a context where that information was fairly sensitive, and companies really balked at the requirement to have to do that, and to have to go back and do it retroactively made it even worse. So what the SEC has done is proposed an alternative valuation approach for how you can get financial information to the participants by providing them with your 409A valuation report as an alternative to providing them with the actual financial statements of the company. But Scott, as you and I have talked, there are some problems with that, in that those reports actually provide more information than what you would necessarily see in the financial statements. And they deal with future as well as past events. And therefore, I don't know that companies are all that enthusiastic that this is a solution to what is an ongoing problem in terms of how do you share your financial information of a private entity with your employees so that they can make a reasonable investment decision, while at the same time securing that information and its confidentiality for the benefit of the company.
Now, yeah, absolutely, Mark. And Brock, we've been on this for a long time, I mean, the entire high technology community has been on this issue, although it's probably even more than the technology community, the biotech community. It's everyone who's private that is having to give out this financial information to employees in a highly competitive market, where those employees might not be employees in 2 months, where they may be jumping to 2 or 3 other competitive companies. California doesn't even have a non-compete law, doesn't even permit non-competes in most cases. And just giving financial information out to people was really problematic, and companies really they balked at it. They had to do it, or else they faced an SEC investigation. But it was a problem. So we suggested, and this is the ABA, we suggested in the concept release that the SEC should consider alternatives, and we specifically mentioned the 409A information. And SEC, Sullivan and Cromwell also made that point in their comment letter, and it was very specific. I went back and checked this morning. It's 409A report information. It didn't say the whole report. And what the SEC has said in its proposal is that in order to take advantage of this, you've got to make available to the employees the entirety of the 409A report. And as you just stated, that 409A report has so much more than just financial statements. Okay, it's not an audited report necessarily, but it's got all kinds of projections. It's got kind of market analysis. And I've been talking to my startup partners, my securities partners, and I know other firms have been talking to their partners too. And companies don't want to do this. There's more information in that. That's not going to work. So I think our proposal back to the SEC might well be that it's not the entire report. It's
Selective information.
It's selective information or a summary, a summary of the report where you can basically say what the value of the stock is based on an outside opinion, and that should be good enough. They shouldn't require the entirety of the report. And by the way, the report's 77 pages, and I can't understand the report in many cases. And I just don't think it's going to be helpful, and it's just not going to be a way around giving financial information.
Yeah, no, I think that's true. So, I mean, what the good news is that the SEC is at least open to the suggestion that there might be some alternatives. I think we have to kind of work with them to refine what those alternatives are, because they don't, the one that they're proposing right now, really, it doesn't change the issue from the company standpoint in terms of the kind of information that it's having to give out to its employees. And it's more information than they need, and information, as you said, that with the mobility of workers these days is not likely to stay confidential, which is one of the, I think, key aspects of this that companies struggle with. And we haven't yet to come up with, in all the years that the 701 has been around, to come up with a way of figuring out how to provide that information so that it's available to the employees, but it doesn't put the company in jeopardy.
And then, by the way, that same issue is out there with respect to 12G. If you remember, 12G had a similar requirement to give financial information to people. If you exceeded a certain number, they changed that rule to make it harder to trip. But you know, it's a problem. I mean, they've got to keep thinking about how to address it.
Yeah. Some of the other proposals that are in the rules, I think, a little bit overdue. Yeah, there's a requirement that you can only sell $1 million worth of stock in a 12-month period, or the greater of $1 million, or 15% of the outstanding assets, or 15% of the outstanding securities. The SEC is proposing to raise the limit for the asset percentage from 15 to 25, which is probably long overdue, and to raise the dollar limit from $1 million to $2 million, which I think will provide some, at least for startup companies, provide a little bit more flexibility to them in terms of what they're able to do within a 12-month period, particularly if it's a fast-growing company. Age of financial statements, the proposal would change the age of the financials that have to be, right now they have to be within 180 days, current within 180 days of when the proposed sale is going to be. The SEC is looking at adjusting those rules so that the financial statements can be provided on a semi-annual rather than a quarterly basis, which ought to make things a little bit easier for companies in terms of having to provide that information regardless of what the form ends up being. Another issue that I think is still kind of not resolved in the way that we would like it to be, and I'm not sure that it ever will be, and that is the timing of when the information has to be delivered when you're dealing with derivative securities. Right now, the SEC takes the position that the information has to be given before the sale of the security. And when you're dealing with an option or an SAR, that's viewed as being the date of exercise of the instrument. However, derivative securities such as RSUs which don't have an exercise or a conversion price, the SEC has taken the position for a long time, and I know, Scott, that you have been a big crusader against this, that you have to actually provide the information to them before the date that the award is granted. And that creates some of its own problems, particularly with new employees who obviously are still contemplating whether or not they're going to join the company, and receiving that information in advance of making that decision is not in the company's best interest. So what the SEC is proposing there is to provide a carve-out for new hires, so that someone who is being granted an RSU in connection with joining the company would actually be, the rule would actually be satisfied if they provided the information within 14 days after they joined the company, rather than having to give it to them before the date of grant. But other than that, they still are taking the position that the treatment or the settlement of an RSU is not similar to the exercise or conversion of an option or an SAR, and taking the position that before you grant an RSU to an existing employee, you have to make sure that you've provided them with the information at the same time or prior to the time of grant.
And Mark, this, as you know, I mean, you said it, you've saved it for last, but this is one of the big issues that I think is out there currently with respect to 701. And look, it's driven by the same issue that drove the necessity to raise the limit to 10 million, and the same issue that says that 10 million is probably problematic too. And that is that because of 409A reports, especially in the tax area, among other things, the valuation of equity has increased substantially. And of course, you've got unicorns out there, et cetera, and companies being more valuable as private companies. And the fact is that options are at least in technology companies, but even in non-technology companies and non-bio companies, are not necessarily used once a company gets fairly big in size and is past its C round, for example, of equity issuances. And what companies are starting to use RSUs in various forms. And the problem of having to put something out there immediately with an RSU is that, you know, you've got to get ahead of that curve, and especially in the new hire situation, how do you do that? But unfortunately, it's broader than that. And what we've been asking the SEC to do for a long time is to basically say that RSUs, because they have zero strike price, I mean, it's effectively given to an employee for services. There's no effective investment decision that's being made. That the SEC should basically say that you don't have to provide that kind of information with respect to RSUs at all, and that you shouldn't have to, you know, worry about whether that is in fact an investment decision that requires disclosure. Now, the SEC has, in fairness, said that they do respect the no sale theory, and there may be appropriate cases where there isn't a sale. You know, we could talk and we could kind of discuss about whether there's ever that situation where there's an investment decision that's not a no sale. But the fact is that the SEC hasn't clearly said that it's exempt from having to either have a registration statement or, in the case of 701, qualify for the exemption, give out the information. And so it's still a problem. I think we are, as part of the ABA, at fault for kind of giving them the easy out of dealing with new employees and saying, oh, well, we've given you what you needed because new employees are the toughest piece of that. And we've given you a 14-day grace period. And I think, again, we ought to readdress it and once again say, no, you know, that's good. Thank you very much. But we really need it for all employees. And would you reconsider it? I don't think they'll do it, but we ought to ask them again.
Yeah. A couple other things to mention. In business combination transactions, the SEC is proposing that in a situation where an acquired company's equity awards are assumed by the acquirer rather than accelerated, that they will not count against the limit of the acquirer. for purposes of determining whether or not they've exceeded the $1 million or the annual limit or the $10 million limit, as long as they provide the required information under 701E. And it seems to me that that's probably the right solution in something that has been a headache for companies for some time in determining whether or not if they were assuming awards from a private company, whether they had to comply with 701 as part of their 701 compliance. Instead, as long as the originating company has complied with 701, then those awards won't count against the awards that are outstanding of the acquirer company. And then finally, eligibility. I think Keith touched upon this a minute ago. The SEC is proposing to expand, similar to Form S-8, eligibility to use 701 to groups, small groups, other than natural persons, where there are no more than 25 people and they're still providing bona fide services to the company, which I think makes sense given the way some people want to structure their business relationships. And this allows them to use the exemption without having any undue problems. There's also an extension of the rule with respect to former employees, so that someone who leaves the company can still get an award under Rule 701 as long as it relates to services that the person has provided within the prior 12 months before the time they left the company. And then finally, they're looking to change the definition of subsidiaries, or to allow employees of subsidiaries, not just majority subsidiaries, which is what the rule currently calls for, to be eligible to participate in Rule 701 as well. So in a couple of different areas, they're sort of expanding the group of potential participants to make it easier for companies in situations that come up fairly regularly to include individuals within their 701 offerings without having to deal with some of these technical headaches that have plagued practitioners for quite a while. Anything else that I forgot?
No, that's all.
That was good.
So, let me go on from there then, Mark, and, in the last few minutes that we have, talk about the real concept portion of the original concept release that the SEC put out there. The concept release was initially in 2018 as a proposal for all these issues combined. But when they got comment letters from everyone, they divided it into two different releases, as you mentioned. One was what we've been talking about, and the second deals with this issue of what I'll quote, platform workers, unquote.
A term that I think you coined.
I think I coined it for good and for bad. We were working on the comment letter for the ABA, and we kind of went through it. But let me give a little bit of history, because I think it's really valuable. And that is that in many of these meetings we have had with the SEC, when we talk to them about the issues that we've been discussing, we also talked with them about the fact that the definition of employee, consultant, advisor, which is what 701 and S-8 basically covered, was not broad enough. They had, from a regulatory perspective, expanded it to a term called de facto employee, end quote, who was a worker that provided at least 50% of their time to the organization, but wasn't otherwise an employee or a consultant to the organization. And it had a lot of history going back to, it's certainly not the gig economy. That's where it came from. And I think it was the jobbers or something that were salesmen that really were covered by that rule long ago. But we said, look, the definition of de facto employee isn't broad enough for companies that are starting to develop We called it the gig economy, the on-demand economy, and it just wasn't going to pick up Uber drivers or people that delivered for DoorDash because they weren't employees they weren't employees, and they weren't really providing services to Uber or services to the different restaurants. They were providing services to the ultimate third-party recipient of those services, the person who gets into an Uber, the person who orders by DoorDash, and there was a fee being given to the platform, to DoorDash, to Uber, but they weren't effectively the service recipient. And we said it just doesn't work, and you've got to think through this. And to their credit, they said, look, here's a concept release. You tell us what you think we need. And they asked a number of questions, and I think it was very good. I mean, I think it was a great opportunity. And what they've come up with in this concept release is a proposal to basically take the gig economy, the platform, and they have examples. And the examples are work that involves bona fide services to end users, meaning the public, etc. Using purchasers, using the quote platform of the company, of the issuer, and then that's where the issuer gets the fee. And they gave examples of ride sharing, food delivery, household repairs, dog sitting, dog walking. I take advantage of that service, or tech support for purposes of using the platform. They were also thinking about, and I know that they were thinking about this because Airbnb gave a comment letter to the SEC, and it was cited many times in the release that was just issued of people that rent their houses out to the public using a platform like Airbnb and some of the other providers out there that are doing the same thing, VRBO, etc. So they basically picked up on our suggestion, and they covered this this type of workforce, and they said, look, we'll put out something that if it's adopted, we'll be out there for 5 years as this evolves. We know we're not going to necessarily hit everything in our rules, and we'll see how this evolves, and we'll re-examine it in 5 years. And in that situation, they said, you really got to basically comply with a number of rules that are very technical, and you got to provide us with a lot of information. With respect to the rules, first, the issuer's internet-based or other platform or system is provided by a third party, or is provided for services to end users, and the issuer must receive a fee from the use of the platform. And the issuer must operate and control the platform. Second, the services must be pursuant to a written contract that provides very specifically what the terms of the arrangement are. That's supposed to be very specific in terms of the relationship of the Uber driver to the platform. In addition, there can't be individual negotiation of whatever the amount of equity is to be given to the driver, to the deliverer, or to the host or hostess of the real estate. In addition, you can't sell at this point tangible real property, tangible personal property as part of this service. So it's specific to real services, not sales. Again, Airbnb isn't really a service; it's really a short-term rental, but they continue it. They consider it a service, and this is a very important requirement, and it's something that we highlighted in our letter. No more than a certain amount. In this case, the SEC has prescribed 15% of the annual compensation during a 12-month period must be in the form of equity, and over a 3-year period, it can't exceed, valued at the time that it's initially granted, $75,000 of value. We came up with that as a way to deal with the issue that was raised when we had meetings with the SEC and suggested that they need to be considering the fact that that they want stock to be secondary as a form of compensation, not the primary compensation. They want cash to be that primary compensation. Now, why do I say that? They didn't really care what's paid to the individual. I say it because one of the issues that was raised by the SEC when we met with them was, what stops someone from manipulating this possible exemption and having someone say, I don't want any money, I just want to basically get stock, and then I'm going to resell it. I'm gonna go resell it, and I'm going to be a distributor of this equity. That's not what the SEC wanted. That's not what 701 or S-8 is about in principle, and we kind of understood that.
Sure.
And so we proposed in our letter, Mark and Keith, that they could impose some limit of the compensation being in the form of equity, and they picked us, and they picked up on that, and they put out this proposal for a limit, and you know, whether or not it's 15% or 20% or whatever, what the number is, whether it's 75,000 or 100,000, it really doesn't make a difference. The fact is that it's good to have some limit so that you can confine this to really what it's about, which is equity as some form of a compensation, not as the exclusive form of the compensation. In addition, just like 701 generally, use of this exemption can't be for a capital raising purpose, and it's got to be, again, for selling goods and services, services, etc. And 6, the SEC is proposing that reasonable restrictions on transferability must be out there. In addition, the SEC has a number of requirements in order to take advantage of this exemption that would require reporting to the SEC. I won't go into those. They're very well stated, and they're not really, to me, controversial in the release itself. But they want to get information. This is not to make it hard on everybody. They want to get information so that they can see whether they're on the right
How it's
track
being used.
5 years from now.
Right.
How is this being used? And this is effectively the way to do it. So I think it's rational, and I think it's reasonable, however it ends up. The concluding thing I would say about this is that this is really a good start. And I think that companies have not reacted to this yet in any kind of proposals. Mark, you and I talked about some of the comment letters that have been received on this. They've all been by individuals. I think there's 14. And we talked about them being mostly against. I counted them. I read them again. They're very short. They're a paragraph each.
Yeah, and they're not.
They're 50-50. They're 50-50. 50% of the people want the stock opportunity, and 50% said, "Oh no, people are trying to game me. You know, they're just not wanting to pay me the cash." Well, that's a different issue. But I think that you know, right now companies have not reacted to this yet. I expect by the time the comment period is over that there's going to be a lot of reaction to this by the Airbnbs, by the Ubers, by the DoorDashes, by the host of companies that now, even since the proposal has come out, have gone public, because a lot of those companies have actually gone public. And you know, this is applicable to 701 and S-8. So I think that's the concept release. And I think, you know, there's a lot of meat to it.
What do you think? I'd be interested in what each of you think, given the fact that this is all happening during a transition period. It'd be one thing if this proposal came out from a commission that would then gather in the comments, analyze what they've seen, and make a decision on a final rule. But we're going to have, it was a 3-2 vote, I think, on both of the releases. And you know, we're going to have a new chair to the SEC in the next few months. So the balance of power, or I should say the philosophy even, has sort of tilted or potentially tilted away from what it was before. Do we think that these, it would seem to me that the first release, the one that's the more technical in nature, probably has the greatest chance of succeeding, simply because there isn't really anything in there that I think is going to generate a huge amount of opposition. but do you think this platform workers concept will get a chance?
I wouldn't bet on it. I don't think it wasn't in Andrew Ross Sorkin had his deal book today, had 5 issues for the new chair of the SEC. This wasn't on the list. And this was obviously Commissioners Lee and Crenshaw thought this was not a good idea or expressed some antipathy toward it. So I would not expect to see, I don't know what chair, if Chair Gensler becomes the chair. I'm not sure what his views will be, but I would be surprised to see this as there's a lot going on in this. It's not related to the securities laws, I think, that will keep it from.
I just want to be an optimist on this.
Oh, yeah.
And I mean, I share the technical issues of the vote and the commission, division right now and what it might be in the future. But this is such, I mean, this time has come. I mean, we've got a changed economy. The pandemic has made it even more of a changed economy. People are not going to be going back into the office. Different jobs are going to come up. Different arrangements are going to come up. The old is going to be changed just even more because of what's happened in the past 10 months and the pandemic. And I think that these people are going to be open to something which is a little bit revolutionary and for a 5-year period, try it out. I'm hopeful. I'm hopeful.
Yeah, well, we'll see. I wouldn't put it in the backlog if I were you, Scott. I just don't think that's happened. By the way, the 5 list was political spending disclosure, restrictions on stock buybacks, ordering corporate disclosures on diversity, mandating corporate disclosures on climate change, and formulating rules on cryptocurrencies. That's what is in the deal book. So.
And clawback. And clawback.
Oh yeah, we'll probably see that. Finishing up the Dodd-Frank.
Keith, do you know, I'm curious to know, I hadn't run into an SEC rule before that was put in for a fixed period of time. Is that a relatively novel concept for the SEC to use?
It is. I'm trying to think of any. Certainly none when I was there.
Yeah.
I can't remember any during my time when.
Yeah, I don't remember any. So Scott, I wore platform shoes as my dress shoes when I was a teenager in the 70s. So I don't know if that somehow creeped into your mind when you were coining the term platform workers.
I sat down with my associate and we kind of came up with this as a defined term, and we were thinking about so many different things, and I won't even go into all the things that we kind of started with, but platform contributor kind of is a nice way of putting it. It can't be very controversial to say platform contributor.
No. Same initials as Piggly Wiggly, the supermarket chain down in the Southeast. So thank you so much for your time. I know, Scott and Keith, this is beyond your retirement date, so I really am grateful for you participating.
Yes, and thank you for taking time when you didn't have to.
Yeah, and Mark, thanks to you as always. Have a good day. Thank you.
Thanks, Brock.
Thank you. Bye-bye.
Thanks, Brock.
Guys.